So yeah, let's get right into it. So what are bonds? Bonds are issued by companies and governments when they want to raise money. When you want to buy a bond, you're basically loaning a company money and they agree to pay you back at a specific date and they pay you interest payments. Now, companies can issue bonds, but mostly bonds are issued by governments because governments are more stable. They can raise tax money, they're safer. And if they need to cover the bond debt, it's a much better option than buying from an individual company. And these bonds are higher quality, and there's we can get right into the types of bonds there are. There are municipal bonds, which are issued by the state. You have corporate bonds, which are higher yielding bonds, but they're not as safe. Junk bonds, obviously, they are what they are. Very high yield, but very risky to buy into them because you may not get your money back. And then government bonds, which are lower yields, but are very safe, excellent safety ratings.
Yeah, so I just want to throw in there. Actually, I can talk about it after. I mean, I just wanted to throw in that in terms of safety rating and maturity dates, safety ratings, they apply to regular bonds. They don't really apply to bond ETFs. If you have a bond, you have a bond ETF, it's safe. Nothing's going to happen to it. So I just want to throw that.
Because it's managed by someone and they're managing it every quarter, every 6 months, and they're adding and taking out and putting in the right bonds that you need into it. So you don't have to worry about that. So let's talk about what bonds are for and why you would what are the benefits of even having a bond. So number one, you can receive a steady stream of income via dividends and interest payments. Number two, they tend to offset volatility of owning stocks. And also, you will not see any payments if the company is growing, or you may not see any added benefit of owning the bond if the company is growing or if the company is not doing so well and the stock's going down, because you're still going to have your fixed income. So you don't have to worry about the market crashing or the stock blowing up because you're always going to have your fixed income.
Yep, that's pretty good. And then should you own bonds and how much, if you want to touch on that?
Yeah. So should you own bonds? If you're in your 20s and your 30s, you probably don't need to have bonds. It's more of a hedge against stocks to protect yourself from high volatility or a market crash. You want to protect your investment if you have a lot of money in there. The general rule of thumb, which I've seen on a lot of different websites, is you take 100 and you subtract your age, and that's what you should have in bonds, in stocks, and then the rest you should have in bonds. So, for instance, if you're 30 years old, you take 100, subtract 30, that's 70. 70% of your portfolio should be in stocks. So you want to take more chances at 30 years old. 30% should be in bonds. That's a good general rule of thumb. If it's like, I want to buy bonds, but I don't know how much, that's what you should do for a formula. So.
All right, and then let me just throw in bond ETFs. So there's bonds and there's bond ETFs. Bonds have maturity dates. If you buy a bond, you're loaning out money to someone. You're guaranteed, unless the bond goes defaults.
Right.
You're pretty much guaranteed to get your money back and interest as long as you hold it all the way through its maturity date. So if you have a 1-year maturity date, you'll hold it for a year. You'll get all your money back and interest. Bond ETFs don't have maturity dates. So it's basically a bunch of bonds all in one, and the portfolio manager is taking them in and out. They're maturing, and then they're adding new ones, but they don't have maturity dates. So when the market crashes, generally bonds typically go up when stocks go down. So it's still good to have bond ETFs. They're just a little bit different than regular bonds. Bonds are mostly traded over the counter, and I think you see them in mutual funds more often too.
Yeah. Mutual funds typically have target dates. So the closer you get to retirement, they'll sell some of your stocks and put more money into bond allocation so that your money's safer as you get closer to retirement. You want to take less risk. That's what bonds are for. You want to take less risk and you don't want to lose money. but you're also not going to make a ton of money because there's not a lot of high growth with bonds. And I just want to clear up one thing. I said you will not see any payments if your company is growing. What I meant by that is if you owned a bond and there's a big growth spur as far as if it's like an individual ETF, you're not going to see a huge benefit from that because bonds are very steady. They don't go, there's no huge up and down shifts. It tends to be a pretty straight line. So it's more of a fixed income asset. So
Yep.
I just wanted to clear that up. But I think that's pretty much it for bonds. It's pretty simple, pretty straightforward. Use the 100 rule to figure out how much you need to buy. And that's it.
All right. Merry Christmas, guys. Happy
Merry
holidays.
Christmas. Happy holidays.
Yep, that's pretty much it.
And don't forget to subscribe and use our links for Robinhood and Acorns. You get $5 when you use the Acorns one. And with Robinhood, you get a free stock.